Hello and welcome to ChooseFI. I'm your host, Brad Barrett, and today on the show we have Brian Feroldi on to talk about many of the lessons he's picked up over his nearly 2 decades as an investor. And it's fascinating how there's a common thread of understanding history and understanding psychology and thinking long term. And I think you're really going to enjoy this episode where we go through the tactical and then zoom out to talk really broad-based lessons on how to succeed as an investor over an investing lifetime. With that, welcome to ChooseFI. Brian, my friend, welcome back to ChooseFI. It's always great to have you here.
Brad, it is always a pleasure to be here. Thank you for having me.
Yeah, this should be fun. So, you obviously are prolific on Twitter. And you are extraordinary on Twitter, frankly. So I think at last count, you have nearly 500,000 followers on Twitter, which is absolutely unbelievable. But honestly, it's not unbelievable when you see the amount of content and the quality of content you're putting out. And you put out a bunch of Twitter threads recently that I wish we could spend an entire episode talking about each of them, frankly, because I think there's a lot there. But the one that piqued my interest the most and I thought would be great for a wide-ranging conversation. I think what's so great about you is you can get down to the minute tactical, but then zoom out and look at, okay, what's the psychology? What are the things that I need to know to succeed over a long period of time? And I think it's a really interesting skill to be able to do both, frankly. So kudos to you, obviously. But I want to dive into these. This post is, I've been investing for 18 years. Here are 38 short investing truths I've learned the hard way. Now, obviously, Brian, we're not going to do all 38, but let's try to bomb through as many of these as we can and just talk about it with our own backgrounds, because I think that gives some flavor on these truths and really people can see how it's applicable to their own lives.
Yeah, if you are an investor for any period of time, you're going to learn a lot of lessons along the way. And it is going to be painful to learn those lessons. And that applies, by the way, if you're doing the thing that ChooseFI suggests, and I suggest to 99% of people, which is just dollar cost average into index funds. If you follow that path, that is dead simple, you are still going to learn a lot of lessons along the way because markets are volatile and volatility wreaks havoc on human emotions. So I think many of these lessons will apply to you even if you don't buy individual stocks like I do.
Yeah, wholeheartedly agree. And I think just as recently as March of 2020 exposed a lot of us, myself very much included, to the potential cognitive issues that we have that we weren't aware that we did have, frankly. I thought that I had my investor policy statement. I thought I was bulletproof in terms of the behavioral side of this. And I learned very quickly that when the sky is falling, my brain went to some pretty dark places. And I didn't make dramatically negative decisions, but man, Brian, my brain went there. And I think that's what's so important about having a conversation like this, about understanding that even people who think they know what they're doing, we're susceptible to this just as much as anybody else.
Yeah, that just goes to show that you are indeed a human, Brad. And like you just teed up, you have an investor policy statement. I know that your finances are rock solid. You've been following the FIRE lifestyle for a couple of decades now. So if there's anybody that is well positioned to handle mentally the volatility that's going to be thrown your way by investing in the stock market, it's you. And even by your own accord, you struggled with it. So you can imagine how hard it is to deal with the volatility of the markets if you didn't have those things taken care of ahead of time, if you had debt to your name, if you weren't so on top of your personal finances. So yeah, let's just get that out of the way up front. Investing is hard.
Yeah, it is hard. And we try to talk about, okay, this is a long-term thing. Think in terms of decades or many decades, not in terms of months or quarters or even years, but it still is hard. And I think that's what's so important about this. So let's get into it. Where do you want to start with the important truths that you've come across?
Well, I think the most important one to start with, or at least a very important one to start with, is the first one in the tweet storm, which is just, you're going to be wrong a lot. Period, full stop, end of story. Now, that lesson mostly applies to people like myself who make individual investments into either stocks or real estate or into cryptocurrencies. If you're buying individual assets, you have to go in knowing ahead of time that you are going to be wrong a lot. One reason that index investing works so well is that all of those mistakes that you make by investing in the stock market are actually completely hidden from your view. If you buy the total stock market index, what most people don't know is that about 2/3 of the thousands of the stocks that they buy when they make that investment underperform the index overall, and actually 40% of those have a negative, a real return. So even if you're buying the index and you're buying every stock that exists out there, by definition, the vast majority of the companies that you're buying are going to lose you money. The reason that index investing works so well is that you're guaranteed to get all of the mega winners in your portfolio as well. And crucially, all of that chaos is hidden from your view. So the chaos of companies losing money, you don't see, you just see one number on a screen that shows you the value of the total market index. But just know, if you're making individual stock selection or individual investments, know ahead of time, plan for it. You're going to be wrong a lot.
Right. And that's just part and parcel of, okay, this is the strategy. I have to understand that. Even doing a ton of research, right? I know you've talked about on previous episodes the spreadsheets you have and the different categories and how you're going back and updating that. I mean, like you said, 40% of stocks in an index are going down every year. I obviously don't know specifically what percent of yours are winners and losers, but undoubtedly, even amongst these highly curated stocks that you personally have bought, it's littered with losers. But yet, the few mega winners, a la Tesla, are far outweighing the potential losses, these potentially small losses that just essentially rounded down to zero in your case. And because you understand the strategy, it's amounted to this big net win. At least that's how I conceptualize it. I'd love to hear, does that ring true with you?
Not only does that ring true with me, that rings true with the greatest investors of all time. Everybody knows that Warren Buffett is a master investor. He's been doing it for 60 years. Even Buffett himself has admitted, if you take away our 10 best investments that we've ever made, our track record would be perfectly average. And people think that if Warren Buffett likes a stock, it's going to be a guaranteed winner. Warren Buffett has bought plenty of stocks that have lost him billions of dollars over time. But that doesn't matter because he also bought Coca-Cola. He also bought See's Candy. He also bought Geico. And the returns from those few mega winners have literally made him the greatest investor of all time. But make no mistake, Warren Buffett has been wrong a lot on investments.
Yeah. And he's a perfect case study for this, right? Because you're going to be wrong a lot, but that means you have to be open minded and you have to be willing to change your mind. I mean, his purchase of Apple after many, many years and decades of being overtly anti technology, Apple is now, at least to my understanding or my recollection, the biggest holding they have. And it's been a remarkable winner. And that's a 80 something year old man changing his mind. And I think that's a remarkable skill for all of us is, okay, look, the world changes and you have to keep up with, hey, I can't just get my head stuck in the sand and stick to one opinion for the rest of my life. I need to constantly look at the facts and be willing to update my own thought process. And I think that's really important.
Yeah, Buffett was famous for decades of ignoring technology stocks. He just said, I don't understand it. I don't see the competitive advantage. It's not for me. And funny enough, one of the first times he broke that rule, he didn't do well. Buffett made headlines about 10 years ago when he took a huge position in IBM, and he held that position for a period of about 5 years, and he ended up actually losing money on that position. And rather than being deterred, he sold off of IBM and then plowed a huge amount of Berkshire's capital into Apple. And I'm pretty sure that they have made more money on their investment in Apple than they have on every other investment that they've made combined. I'm not 100% sure on that, but I know that the gains from their Apple purchase have been enormous, tens of billions of dollars.
Right. And yeah, even if it's not exact, it's certainly directionally accurate. It's a remarkable, remarkable thing. All right, Brian, what's the next truth you want to talk about?
Well, how about this one? I think if you invested at all, you know this truth all too well. Losing money hurts about 3 times more than making money feels good. What that means is that if you made an investment, $1,000 investment that went to zero, that would be as emotionally painful as seeing that same $1,000 investment going to $4,000 would feel good. Humans have dozens of innate biases built into them. One is called loss aversion bias, and we are just programmed to feel the pain of loss far more than we are programmed to feel the pain of gains as people.
Hmm. Yeah, I certainly have heard of and I'm aware of loss aversion, but I wonder what's the takeaway in terms of, okay, these behavioral biases, it's important to be aware of them. But is there something that you've done that might potentially change behavior? Or is it just the awareness alone is critical to you?
Yeah, I think that awareness just speaks volumes about it. Just somebody saying those things out loud has really helped me to be like, oh, other people experience this too. I'm pre programmed to feel like that. That makes me feel so much better as an investor. But it's funny, if you talk to an investor, many of them might not be able to, off the top of their head, tell you the biggest winners that they've had or some great investments, but every single one of them can tell you the stock that they bought and went down 90%. And we're just so hardwired to focus on the losses as opposed to the gains.
Yeah. What you said in there, quote, other people feel that too. I think that might be the most universal truth about humanity is it does feel better when you understand that it's not just you. I think a lot of us, and this is not certainly not just limited to investing, I think a lot of us think the issues that we're dealing with or our problems are maybe just us in a silo and we suffer in silence. And I think this is a perfect example of, hey, there are other people out there like me. And I think clearly with these innate biases, just becoming aware of them and just doing a simple Google search for most common cognitive biases, just being aware of that. Like, oh, wow, that does happen to me all the time. And it's not just me, it's literally 8 billion people. So, yeah, that's a great one, Brian. I love it.
Yeah, a side note, Charlie Munger has a wonderful talk that he's given called The Psychology of Human Misjudgment, and it essentially lists through a couple of dozen innate human biases that they've had. If you've never listened to it before, just go and find that talk and listen to it and listen to him rattle off the ways that humans make bad decisions. And if you're like me, you'll be nodding your head like, yep, I've done that. Yep, I've done that. Yep, I've done that. It's just amazing.
That's brilliant. Yep, we'll definitely try to find that and put that in the show notes. And I think he has something similar in the Poor Charlie's Almanac book as well, which is just a masterpiece if anybody's looking for a 20-pound, $80 book to pick up that's just filled with Mr. Munger's wisdom. All right, Brian, what's up next?
How about this? Humans are pre programmed to be bad at investing. Those biases that we talk about, they make us naturally bad investors. And a huge amount of learning to invest well is coming up with systems or educating yourself to overcome your innate biases that make it so hard to make money in the markets. A real simple example is when are people, and I've seen this firsthand over the last couple of years, when are people most interested in investing? The answer is at market tops. Why? Because they know people in their real life that are bragging about how much money they have made in the market. And they look back at the recent returns and they look fantastic. And it seems it's the most perfect time to get in because we take our cues from other people. We want to mimic what other people are doing. So the time that it feels best, that feels riskless to invest, is when the market is nearing its peak. The inverse, of course, is also true. The time that we are most disgusted with investing, the least willing to put our capital at risk, is when markets have gone down dramatically recently. That's because other people have lost money in the markets. You see just a sea of red everywhere. There's just mass negativity. And we want to naturally fit in with the herd, do exactly like we see our peers doing. So knowing that, it's very common for investors to want to get in at the top and sell out at the bottom. That's just how we're programmed. So know ahead of time, if you have those urges, it's because you're human and you're pre-programmed to be a bad investor.
Yeah, two things immediately spring to mind. First, Mr. Buffett's quote, be fearful when others are greedy and be greedy when others are fearful. And just not to pick on Kathy Wood by any means, but Kathy Wood and her ARK investing funds, I think the inflows to their funds when it was at the absolute peak of the returns were extraordinary after it had already gone up. And I think many of them, and I don't have the exact numbers in front of me, but many of them are down 40, 50, 60% since those highs. And it's just, it is very, very interesting. We're herd animals. Like, we're talking about base human instincts. And yeah, when you see other people making money, when you hear other people talking about things, you get interested. It's just the way we are.
Yep. It's just really important to acknowledge that up front. So many things, so many times doing the right thing from an investing perspective literally it feels in your gut like you're doing the exact wrong thing. Nobody wants to sell at the high. Nobody wants to buy at the bottom. This is why taking your emotions out of the equation by just dollar cost averaging, committing the same amount of money on a fixed schedule works so well, because you remove those emotions from the equation and just keep things automatic. So that's again why dollar cost averaging works, is because you overcome your innate biases through automation.
Yeah. All right, Brian, that was a great one. Let's keep rocking and rolling here. What's next on your list?
Yeah, this one is borrowed heavily from Morgan Housel, and that is successful investing requires an uncomfortable mix of both pessimism and optimism, which is damn hard for our brains to handle. I think Morgan Housel said it best when he said, save like a pessimist, invest like an optimist. What that essentially means is be really conservative with your personal finances, right? Have a high savings rate, have multiple sources of income, have an emergency fund built in, and save like the near term is going to be brutal, like some bad stuff is going to happen. But investing, by its very nature, is a bet on optimism. It's a bet on the continued success of the human race. It's a bet that life is going to get better, companies are going to come along, technologies are going to come along, and we're all going to prosper as a species. So it's important to keep both emotions in mind, short-term pessimism and long-term optimism. And actually, if you get too one-sided, if you become a perma-pessimist and you position your portfolio as if the world's going to get worse, you might be right in the short term, but in the long term, you're almost guaranteed to fail. And the opposite is also true. If you take on a lot of leverage, you invest, you put all of your money into investments, assuming that everything is going to be sunshine and roses forever, well, you're going to get burned as soon as there's an inevitable downturn. So keeping both emotions in mind and balanced, short-term pessimism, long-term optimism, is the key to success.
Yeah, yet another hard thing for our brains to handle. You're absolutely right. And I think the short-term pessimism, to me, like, I don't necessarily view it in my own mind as pessimism necessarily, as much as, though I guess upon reflection, that is what it is, in that things are never rosy forever. We talk about a rainy day for a reason, because things outside of your control often happen. You might lose a job. And if you are literally spending 100% of your income. I mean, this is the fundamental of financial independence, is if you are spending 100% of your income, then you are at that edge at every given moment. And during the good times, it might feel wonderful, right? We're making a lot of money, we're freewheeling, we're enjoying life. But man, that underlying stress that has to always be there when you lie down at night and you realize, if anything happens, anything, we're on a knife's edge. And that is not a way to live. So I think clearly understanding that, all right, life is sometimes going to be lumpy and throw things at us. We need to save some money. But yet, right, the ingenuity of humanity as a whole leads you to believe that investing for the long term is the best possible way to grow your wealth. So it's important to do both of these things. And that's a hard thing. But like you said, the perma bears. I mean, there are so many of these people, and they get off on it. They really do. It's astonishing, right? Like, I think people think they're smart when they talk doom and gloom. And there's something there that's hard to even discern. But I think there's just something alluring about doom and gloom. But it runs counter to what we see in actuality, which is, you look at, and I know many of your tweet threads are, hey, what does the stock market look like over 100-year period? I'm picturing a graph that I've seen on one of your recent tweet threads, maybe from the day we're recording this, actually. It just is up and to the right. And amongst that 100 years, there were world wars, There were terrorist issues. There were everything you could imagine. And it's up and to the right. So there's good cause to be optimistic long term. And I think it's really important. And like you said, if you're a perma bear and you're a perma pessimist, you're not going to invest. You're going to sit on the sideline and think of how brilliant you are. And you're going to miss out on all of that wealth accumulation and growth over decades.
Yeah, it's been said that perma bears get on TV and perma bears get clicks, but it's really the optimists that really make the long term money.
Wholeheartedly agreed. All right, Brian, what's up next?
How about this one? I know you're going to love it. 99% of investors should dollar cost average into index funds and call it a day. And I think people in the ChooseFI community know me as someone that loves individual stock selection. I love everything about the stock picking process. I like researching companies. I like the mental challenge that goes along with it. I like following companies. But I know that 99% of people are not cut out for that because mostly they're just not interested in managing their money that closely, which is why I firmly believe 99% of people that want to invest in the market should just dollar cost average into index funds and call it a day.
Boom. Nothing really to follow up on that. I totally agree, obviously. And I think it's so counterintuitive in the sense that most people have this feeling that the more effort you put into something and the more intelligence you apply to something, the better the results. And it is one of the most fascinating things that in investing, like you're saying, 95 to 99% of people are going to have the best long term outcome by just dollar cost averaging into index funds. And it's a remarkable thing. Where else? I can't think of any other aspect of life where essentially the brain dead version is going to get me the best results. And I love that. I hate to be so crass about it, but right, that's just the way it is. And it's really important.
Yeah, that is the ultimate formula for automatic wealth building that I've ever seen. Dollar cost averaging plus index funds plus time equals automatic wealth creation, or at least the closest thing that we have to it. And I know that the vast majority of people that are in the FIRE movement do exactly that, myself included with my retirement funds.
Right. Of course. And you've said that many, many times. So, yeah, totally clear that a significant amount of your net worth is in index funds, even though you were the one who opened our eyes to individual stock investing. And I think there's room for both. And like you're saying, you need to have an interest in it. You need to put in the time. There's a lot that goes beyond it. But again, 99% of you, just low cost index fund. And you're gonna do absolutely wonderfully over 30 to 50 years.
Totally agree.
All right, Brian, let's keep on moving.
How about this? History and psychology are the most important subjects for investors to study. I think a lot of people that get into investing, they immediately go to the math side of the equation. They want to study formulas that are out there. They want to analyze financial statements and they want to read SEC filings. They think that that is the key to investing success. And I think that you'll have more of an edge by studying history, specifically market and financial history and psychology, than you will anywhere else. I mean, most of Warren Buffett's most famous quotes and most his reasons for doing the best over a long period of time is they say that they have an edge in psychology more than they have an edge in analysis. And that's doubly true if you're an individual investor. You're not going to have faster computers than the best hedge funds. You can't outtrade them. You can't get information faster than they can. But you do have one massive advantage that they don't. You have permanent capital and you can truly invest with a long-term mindset. That is something that professional investors can't do by their very nature. So the edge that you get as an investor will come from psychology, not from analysis.
Brian, do you have sources that you go to if for even just the most rudimentary of backgrounds for psychology specifically, but history and psychology? If somebody was coming in and say, "Hey, look, I have no background in this, but I'd love to get up to speed." Of course, I can Google it, but any two or three things jump to mind?
One thing that comes to mind is exactly what the Charlie Munger talk that I talked about before, the psychology of human misjudgment. Of course, Morgan Housel recently wrote a fantastic book called The Psychology of Money. Those are two great starting points to really see how people behave with money. And then there's another book out there by Michael Mauboussin. It's a little bit more analytical, but it's called Expectations in Investing. And that gets into the expectations that are built into stock prices and kind of the psychology around that. So there's a couple of resources that come to mind.
Nice. Yeah, that's really helpful. Thank you. All right, what do we have next on the list?
How about this? Consistently avoiding ruin is the most underrated financial skill. When you first start investing, I think a lot of people, myself included, they really want to go after the highest returns possible, right? And one way that you can cheat and get even higher returns is buying assets with leverage. So they get really into stock options. They get into using leverage to grow. They're interested in buying 2, 3, or 4x leveraged ETFs in order to turbocharge their return. What they're overlooking is that age-old math problem. And I'm going to paraphrase a Warren Buffett quote here. And it was a string of impressive numbers multiplied by a single zero equals zero, which is something that so many people overlook. And in your financial life, it's the exact same thing is true. It doesn't matter how good your returns are. If you multiply that by a single zero, or if you single-handedly get wiped out, all the financial progress you've made goes to zero. So setting up your financial life not to maximize returns, but instead to maximize longevity is the thing that investors should focus on.
Yeah, that reminds me of a Munger quote, and he talked about the very few ways where smart people can go broke, and leverage is the number one in that list. And yeah, just essentially putting all your eggs in one basket, it opens you up to, like you're saying, this ruin. And that is just such a powerful word. It's a visceral word, Brian. When you said it before, when you think of ruin, there's no need to do that. Because again, like we talked about, 99% of people can do just fine, extraordinary even in index funds. Why would you open yourself up to ruin for whatever it may be? One single bet, a couple bets, certainly leverage. It makes no sense. So for me, it's about safeguarding and simplicity. That's how I live my life. Obviously, everybody has to do what works for their own life. But yeah, this is a really important one.
By the way, this lesson was learned firsthand by Buffett. A lot of people don't know this story. It's actually one that I came across recently. You ever heard of a guy named Rick Guerin by chance?
I've heard the name. Was that their third partner?
Yes. So a lot of people don't know this. I didn't either. But Warren Buffett and Charlie Munger actually had a third partner from the start named Rick Guerin. And Rick Guerin was a fantastic investor, knew Buffett and Munger extremely well. And he was in a rush to get wealthy. And Guerin was in the bear market of 1973 and 1974. He was using leverage at the time, and the returns during that time were so bad that he effectively got wiped out. And I think Buffett actually ended up buying his massive ownership in Berkshire Hathaway from him during that time frame. So I think that's one reason why Buffett came up with that quote. He saw a close friend of his essentially get wiped out because he did not avoid ruin.
Yeah, and he bought that percentage of Berkshire back for a pittance. And I mean, that would be worth tens upon tens of billions of dollars today. It's extraordinary.
Yeah, that's exactly right. And it just goes to show Rick Guerin, it was an incredible investor. He was alongside Buffett and Charlie Munger right from the beginning. There's no reason he shouldn't be a multi-billionaire today. But because he was in a rush, because he wasn't focused on avoiding ruin, he ended up having a disastrous financial result in 73 and 74 because just one big bear market really ended up taking him out.
Yeah, there is no reliable way to get rich quick. But like we're talking about, and like the financial independence movement talks about, there is a very reliable way to get rich over a medium term. I hate to even say slowly, but a 15-year period. We've talked about this so many times. It is a very replicable path to accumulate wealth over a 10 to 20-year period. Savings rate, long-term investing, boom. And you don't open yourself up to ruin. Brian, this is one that's really going to stick with me. So thank you for that. All right, what's next on the list? This is wonderful. I'm enjoying this.
All right, how's this? Make money, spend less, invest simply, and wait longer is the best financial advice there is. There you go. All the money and financial advice you need in what? 9 words? Make money, spend less, invest simply, wait longer. Follow that formula, you'll build wealth.
Brian, if I had those 9 words 6 years ago, I think I could have not published 600 plus episodes of ChooseFI in millions of words, right? That is our message in 9 words. And I think that is the ultimate truth. It really comes down to, at its essence, those 4 things.
Yeah, I love it when complex topics can be really boiled down to their essence. And I think those words, make more, spend less, invest simply, and wait longer, are about as good as it gets.
Yep, wholeheartedly agreed. All right, what's next?
How about this? Do nothing is almost always the right move. In fact, I would say 99% of the times, do nothing with your investments is the correct action to take. Now, that can somewhat feel like reckless advice. If you pay attention even loosely to the headlines that are out there, sometimes that can absolutely seem like reckless advice. I mean, a year ago, when Russia surprise invaded Ukraine and there were calls for potentially like nuclear war, that was a very scary time to be an investor. I mean, just a human, but a very scary time to be an investor. At the same time, interest rates were being jacked up. It was the highest inflation that we'd seen in about 40 years, and markets were in free fall. 2022 was a very, very tough year for so many people, myself included. Looking back on then, it's so tempting to look at that time period or live through that time period and just think, I should sell everything. I should get out. It's awful right now. But history has proven time and time again that not selling, doing nothing, even in those periods of huge economic and political stress, is almost always the right move. And it can sound so easy. It sounds so easy, right? Do nothing. It sounds easy to do, but that can actually be a very challenging thing to do if you're at all aware of what's going on in the world.
Yeah, Brian, I hear you. And I think we are prone to take action, and there's just something that feels good about that. Like you're saying, it feels weird to sit there and do nothing on both sides. And actually, you have some other of these truths that tie in almost precisely to this on both the selling and the buying side. Panic selling once can destroy years of good investment decisions in seconds. And then on the buy side, which we've talked about also here, the stock market will always attract people who are in a rush to build wealth and build wealth for people who are not in a rush. And yeah, that's that last part, and build wealth for people who are not in a rush, right? Who are doing nothing, who are, as we're saying, not exactly nothing, but essentially nothing, which is on a regular schedule buying into the stock market. We've talked about it, right, Brian? Dollar cost average. How many times have we said that? You have this set up automatically. It's everything we've talked about here for this entire episode. It's take your brain out of it. If you want to bring this down to its fundamental essence, how can I get my silly little monkey brain out of my decision making?
Yeah, that's exactly it. I mean, so many things that we've talked about is your brain actively trying to make you less money. And so many of your innate desires and innate traits make it hard to do well as an investor. So, yeah, to your point, come up with systems, come up with policies, come up with financial plans so that you minimize your chance of doing something dumb in the market, which is so, so, so easy to do.
So easy. And like you said, that panic selling, it can erase everything. It can erase all of your gains in seconds. One poor decision. Understand that you're susceptible to that mentally, and just be forewarned the next time. Again, like I said, I was susceptible to it in March of 2020. It's humanity. It's how we're wired. But at least when you're aware of it, you can try to hold back that swell of emotion, because that's what it is. It's these chemicals are flying. Oh my God, the world is coming to an end. I have to panic sell everything. And you just have to understand, okay, that's my brain trying in some way in vain to keep me safe. I can't do that because Brian's told me, because Mr. Buffett's told me, because all of these brilliant experts have told me. I need to understand that, okay, this is normal. Like you said, there are other people like me who are going through this exact thing. And I know what the right decision is. And that's really important.
And this is where I think studying history, especially market history, can be so illuminating. Because when you're living through something and you're seeing the stock market go down, it can feel like it's an unprecedented event, or that it's never been a scarier time to be alive. But if you feel that again just means you haven't studied market history at all. I mean, during the 1950s, for example, schools were practicing hiding under their desk in the event of a nuclear attack. And there was the Cuban Missile Crisis that people had to live through. That was a pretty scary time to be alive. By contrast, I would say that is more concerning than anything that we've had to live through in recent history. And even during that period, the markets, while they did fall, proved to be resilient, and doing nothing was the correct move. So this is why studying history, looking backwards at markets, can be so useful, because when you do, you realize that we've never had it better as humans, even if it feels like we've never had it worse.
Yeah. And I love how so many of these truths tie together. Like you said before, history and psychology, We talked about that throughout. And to your point earlier, which I didn't touch on, is so many people think it's the math that like, oh, you need to be some whiz at math. And I mean, I'm a CPA. I always had some aptitude for math. I don't use actual math in my investing life ever. It's not math. It's I'm setting a schedule to purchase things, and it's psychology. And like you're saying, with a little bit of history littered in there, that's what you need to succeed. It's not the math. It's not some genius. Like you said, 99% of people are going to do just fine investing in low cost index funds. And I think we have one last one that ties in perfectly to investing.
And that is, if you want to build wealth, you have to invest. It is damn hard to save your way to wealth. The stock market, the US stock market, is the greatest wealth creation machine in history, and it allows you to put compound interest on your side. And if you want to build meaningful wealth for yourself, you really don't have an option. You have to save money, you have to invest that money and earn a good return. And I think the best way to do that, the smartest way to do that, the easiest way to do that is to invest in the stock market as simply as you can. And I don't think you have really a choice, especially with inflation rearing its ugly head again. The purchasing power of our dollars has gone down substantially, as anyone that's been to the grocery store recently knows. So if you want to build wealth over the long term, you have to earn a return that outpaces inflation. And the simplest way to do that is to invest in the stock market.
Wholeheartedly agreed. I think the opportunity cost, so many people, again, it's that pessimism, that fear. People think it's risky, but it's not risky. It's volatile, but it's not risky over a long enough timeline. And the opportunity cost of what are they giving up by essentially keeping their money under the mattress or in the freezer or in their Globo bank. That money's just sitting there, and it's going to be the same amount 50 years from now, whereas you would have foregone that entire growth of, in this case, the most electric economy in the history of the world. And you have an option, a very easy, low cost option to purchase with total stock market index funds, a little slice of all of these publicly traded companies. It's an extraordinary time to be alive investing wise, where it's never been easier, right, Brian? I mean, it's never been cheaper or easier to invest than right at this moment.
Yep, that's exactly right. Investors today are incredibly spoiled. I can, in a few seconds, look up the financial information of any publicly traded company in the world. I can get access to conference calls. I can get access to transcripts. I can buy and sell stocks for $0. I can diversify across the United States or the globe. I can play any particular trend that I have. These would have been miracles, or viewed as these would have been incredibly expensive things to do just 30 or 40 years ago. So investors today are incredibly spoiled, and it would be a shame to not take advantage of the blessing that we have.
Agreed. All right, Brian, my friend, as always, thank you for coming on and sharing your wisdom. As everybody knows, they can find you at Brian Feroldi on Twitter, but you have a newsletter, which is phenomenal. It's one of the few newsletters that I subscribe to, and I just love it. It's a quick read every week. How can people get on that newsletter?
Well, thank you for that, Brad. So there's a link directly on my Twitter profile. Otherwise, it's just brianferoldi.com/newsletter.
Nice. Wonderful. Brian, until next time, thanks again for coming on.
Thanks so much, my friend.